Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trow, TPSU, and 401k TV. I review all of last week's stories and select the 5 most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, Cap Trust announced the sale of a minority interest to Carlyle at a reported $3.7 billion valuation, which is almost 3 times greater than in 2020 when GTCR invested. Since then, Cap Trust has added 39 firms, mostly wealth advisors. Along with new fodder to make acquisition, the move signals growing interest in the retirement wealth management industry by new investors like Carlyle, which manages $385 billion globally. Though earlier this year, there were reports that the advisor M&A market was slowing down, DeVoe recently reported that Q3 sales increased in 2023 over last year. There were similar reports from Wise Rhino Group. So even with high interest rates and growing valuations, advisor M&A remains robust, with new money entering and the convergence of wealth and retirement just beginning. Next story, a unique litigation strategy by a new entry into the DC litigation world could bring lawsuits to smaller plans and RPAs. It was reported that the law firm of Leaf, Cabraser, Heinemann, and Bernstein, which boasts 125 attorneys in San Francisco, New York, and Nashville, is contacting plan sponsors before filing a lawsuit seeking settlement. After a lawsuit is filed, the defendants usually file a motion to dismiss, which can be costly and unlikely to prevail as the plaintiffs select the facts which are presumed to be true. And it can put the plans in a position to prove a negative, that fees were not excessive. Will plans and advisors, especially those with insurance, be more likely to settle to avoid costs and reputational harm? Either way, these lawsuits are not going away anytime soon, as the industry eagerly awaits the judge's decision on the FlexPath case, expected out by the end of October. Next story, and what could be a boost for ESG funds, a district court in Texas sided with the DOL in a case brought by 26 states, upholding a rule that stated that ESG factors may be considered by plan sponsors, though not at the expense of returns. The use of ESG funds has slowed as advisors and plans awaited not just the results of the Texas case, but also a potential change in administration and policy. The DOL had lost a lawsuit filed against their fiduciary rule in Florida and decided not to appeal, opting to start from scratch with a new rule now at the GAO, expected out in October. Next story, the long-awaited Portability Service Network is expected to go live October 1st with 2 of its 6 record-keeper members. Alight and Vanguard will go first, followed by Fidelity at the end of the year, with Empower, Principal, and TIA set for 2024. The industry-owned consortium's first goal is to lessen costs and friction when transferring small account balances from one record keeper to another, but has great potential for data sharing and retirement income. Though the 6 providers, along with the Retirement Clearinghouse, own the consortium, all record keepers are welcome, with no preference given to owners who just act as the governing board. Finally, No doubt the challenges of providing financial planning at scale to the 97% of defined contribution participants without a traditional advisor is daunting. Many obstacles exist, like the lack of data and limited engagement, but the industry itself creates many of the barriers which most providers and advisors are unwilling, not unable, to solve. In my most recent wealthmanagement.com column, I cite conflicts of interest, fee compression, industry consolidation, competition between advisors and providers, and antiquated technology as big inhibitors to the convergence of wealth and retirement at work. And though so far big tech and fintech have not been able to significantly penetrate DC plans, they certainly can by circumventing record keepers and plan advisors, going direct to consumers, or working through wealth advisors if the DC industry does not act quickly. So those are the most important and interesting stories from the past week. I listed a few others I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking with you next week on 401k Real Talk.